if you have managed to watch all my modules up to module number 5, may success follow you. Okay, because I believe I've managed to go all the way out just to give this information for free. Some of the people, you know, pay thousands of dollars to get this information, but I'm just giving it for free. So congratulations if you've managed to watch all the modules up to this point. So we want to talk about the module number 5, which is our trading strategy. Okay, so we want to talk about the module number 5, which is the trading strategy. So a trading strategy have got rules. It have got rules. So a trading strategy have got rules, and these are our rules. So I want you to pause this video, write down these rules, and then every time when you place a trade, follow these rules, because there is no strategy that is 100%. I want to repeat this. There is no strategy that is 100%, because most of the times what kills us is we jump from one strategy to another, thinking maybe there is a strategy that if I apply this strategy it will make me profitable. But what's more important is having a strategy that have got rules and sticking to what I taught you in module number 4, money management, and using risk to reward. Then you are sorted, you are covered, guys. So this is rule number 1. You need to identify the market structure. Okay, so remember what we said. We said market is in 3 phases. We've got an uptrend, we've got the sideways market, and then we've got the downtrend. So the first thing that we open our chart, the first rule is we need to identify what the market is doing. Is it in an uptrend? Okay, is it the sideways, or is it the downtrend? So listen to this. We only trade the market that is bullish, okay, or the market that is bearish. So bullish market is going up, bearish market is going down. We don't trade sideways market. So meaning if you open your chart and you see the market is in a sideways like this, just bouncing within a range, just stay out of the market. Do not trade. So we only look for entry opportunities when the market is in an uptrend or in a downtrend. That's the reason why we need to identify the market structure first. So this is the primary rule. If you don't understand market structure, don't place your trade, because you will lose your man. Okay, so identify the market structure. Then rule number 2, mark the break of structure. Okay, the change in direction in the supply or the demand zone. Okay, so the market is going up like this. So if it breaks if it mitigates the previous high, this is a break of structure. Okay, and then it retraces. If it mitigates the previous high, this is a break of structure, something like this. And then if it changes the direction and mitigates the recent low, this is what we call the change of character. So this is what you need to identify. So first you identify if the market is in an uptrend or downtrend. Then after that you mark those levels, the break of structure, the supply or the demand or the change of character. This is number 2. Then number 3, we wait for the market to okay, what is happening? Okay, so number 3, we wait for the market to retrace to our demand zone or our supply zone. So we wait for the market to retrace, and then as it is retracing to our demand zone, we want the market to be printing any reversal patterns. Remember I taught you about I think it was module 2 where I taught about chart patterns, the reversal one, the channel, the flag, and the double top or bottom. So we want the market to trace to our demand or supply zone, printing any of those reversal patterns. Then after that, if we see all those rules being met, if we see 1, 2, 3 being met, then we enter and target the previous high. Simple. You make your mind just like that. And remember, the risk to reward, you only trade 1:3. So meaning even if we have a setup that is meeting all these 3 rules, but it doesn't give us a risk to reward of 1:3, we don't enter it. That's what makes a profitable trader, that separates traders. That's what separates profitable traders from non-profitable traders. Being able to be disciplined and stick to your strategy. Okay, so let's check the charts. Where in case of an uptrend, let's say the market reaches this point, then it is rejected, it retraces, and then eventually it breaks to the upper part like this. So according to our strategy, what you do, we said first you mark this is the break of structure, and then you mark the break of structure, and then you mark the high. When the market starts to retrace, you mark the high, and then we said you mark the demand zone. And then what do you do now? And then we said, what do you do? You mark the demand like this. Then what do? You wait for the market to retrace back to the demand zone, either giving us any of the reversal patterns. Let's say, for instance, here the market begins to give us that channel. This is what you want to see, and then it touches our demand zone, something like this. And what you do now, you need to mark that channel. Okay, you mark that channel, and then if the market give us that print, now what we look for that buying momentum all the way to the previous high, and we set our stop loss right here. So imagine, look at what the risk reward is. It is 1:9. So meaning a trade like this, if you risk $100, you make $900 from a movement like this. So this is a buy scenario. Then the sell scenario is just opposite from the buy scenario. Okay, so I'm just trying to show you. So let's say the market prints a level like this, then it retraces, and then eventually it breaks this level. So what you do, you mark. So what you do, you mark the break of structure, and then you mark your supply zone. You mark your supply zone, and then you wait for the market to retrace. As the market is retracing, you come here, you place the high, and then you wait for the market to retrace. Let's say in this case probably the market retrace, giving us a reversal flag. So you wait for something like this, guys. Then this is where you place your entry. Right here, this is where you place your entry, targeting this point right here. So as simple as that. Let me show you. As you can see from this, the market was in an uptrend. Looking at your left, you can see that the market was in an uptrend, making those higher highs and higher lows, those higher highs and higher lows, up to this point right here. And then what happened now, the market shifted direction. Then the market shifted direction, meaning we are now in a selling momentum. So what do you do? We said, what do you do? Where you have identified that we are now in a selling momentum. So what do? You come here, you mark the break of structure. This is the break of structure, and then after marking the break of structure, what do? Let me remove this one. So after marking the break of structure, you come here. This is the demand, this is the supply zone. You mark your supply zone, and what do? You mark the previous high. So this is the previous high. So what we are waiting for, we're waiting for this market to give us some sort of pattern as it is retracing back to our supply zone, and then from there we place our entry all the way to the downside. So here, what we need, we don't want this market to come here just in a singular movement, but we want to see it giving us some sort of pattern. Remember those patterns that we highlighted there. So we want to see those giving us some sort of maybe a rising channel like this, or a rising flag, and then we place here, and then we have our entry from this point, and then we have our entry from this point going to the downside, something like this. And you can see the risk to reward is 1:4. which in this case it is perfect, guys. So thank you so much. This is Intra Forex. This is the end of our course, guys. Just put this into practice. I tell you, you will see a great change in your trading career. So don't forget to subscribe to my YouTube channel. Kingston signing out.